The American economy growing 6.9% last quarter, beating expectations and capping the strongest year for growth since the 1980s, as the country rebounded, at least in part, from the shock of the coronavirus pandemic. But as inflation continues to surge, the Fed on Wednesday said it will begin to raise interest rates in March. So will that take a bite out of growth in the coming year? Let's ask Jason Trennert. He's chairman and CEO of Strategas, a Baird company. Jason, nice to see you again. So, this paradox of the last month, good growth, nice GDP growth, but the markets are having a terrible time. How do you explain that?
That's right. Well, I think, Paul, it's largely a function of inflation and expectations of much tighter monetary policy. And also an expectation of tighter fiscal policy, not on purpose. It's just the absence of all of the stimulus that we've seen over the last 2 years is clearly not going to be a part of the program in 2022.
Okay, so are you expecting? I mean, looking at the GDP report, is the economy weaker than you think? And when you look at the details, I mean, the big increase in GDP was inventories, which can't keep going up forever. You got to have sales at the end of that.
That's right. And so a good portion, it would be, I think you're at the outer limits of what you can expect in terms of inventories moving forward. You're not going to have the fiscal stimulus, as we said, that you had last year. And so it seems reasonable to expect that the GDP will be meaningfully slower. Real GDP will be meaningfully slower in 2022 than it was in 2021. I think it would be a mistake, however, to think that just because economic growth is slowing, that will automatically result in weaker inflationary pressures. I think a lot of these things have become structural, and it's going to be very difficult, I think, for the Fed, given how far behind the curve they are now. It's going to be very hard for the Fed to rein those inflationary pressures in, even if the economy slows.
Well, that's very interesting, because I heard a very hawkish sounding Chairman Powell at his press conference this last week, focusing on inflation, saying a lot of room to raise rates. I didn't see in their actions, frankly, all that hawkish a Fed. Do you agree?
Well, we'll see. Easing is easy and tightening is hard. And I think we're finding this with the financial markets here. And I think the Fed is going to have a difficult choice to make as things progress, which is do you fight inflation in goods and services, or do you try to save the financial markets? And again, you have to remember that President Biden's approval ratings are where they are, despite the fact that the financial markets hit all-time highs at the end of last year. And Republican and Democratic presidents don't take too kindly to tighter money, generally speaking. And so it seems good, or it seems appropriate in the abstract now. It may not seem so appropriate to the people in the administration if financial markets continue to have a tough time.
Well, the Fed has been signaling 3 interest rate increases off of their near zero bound now for the year, but that would still leave real interest rates negative, meaning a continuing subsidy for credit, meaning still accommodative monetary policy. Is that enough, in your view, to get this inflation under control?
Nowhere near. Paul, I don't think it's anywhere near enough. Even if inflation were 2%, which it was before the pandemic, 0% Fed funds rate is not appropriate. CPI is running at 7. PCE is running at close to 5. So, what's the neutral Fed funds rate when inflation's running at 5? It's certainly not 75 basis points, which would be 3 tightenings. The Fed will also be allowing the size of its balance sheet to run off. That will be a tightening as well. But it seems to me the Fed is very much behind the curve, as is the ECB. And this is something, and also monetary policy acts with a lag. So it's going to be difficult, given all of the stimulus that's been provided, to rein that in. These policies have been enormously good for wealthy people, and they've been very, very tough on just the average person trying to get from one day to the next. They've enriched people with assets, financial assets, and they've impoverished or certainly made them less well off people that just have savings or just have wages. This will start to correct that, but it's going to be in my opinion, it's going to take quite a long time to rein it in.
And you used the phrase before, which was arresting, saving the financial markets. Are you talking about here your expectation? Do you have an expectation of a 20, 30% or more decline in asset prices? We're already seeing crypto collapse. What about stocks?
Yeah, I think, Paul, I wouldn't be so bold to make that claim, but there are certainly a lot of candidates for overcapitalized financial assets and speculative instruments that could see a lot more pain. The S&P 500 is a very strong and well-representative index of companies that represent the U.S. economy, so a lot of them will be fine. But there are a lot of other unprofitable companies, a lot of speculative instruments out there like crypto that, in my opinion, will see more pain as interest rates rise.
All right, Jason Trennert, thanks for coming. Get ready for a bumpy ride.